Let me share my screen and then we'll talk. Where is my share? Okay. So, good morning, everyone. Once again, on the Sunday morning, there are a lot of things that we can do, but definitely we connected to learn more about how we can help our clients, how we can help ourselves, our partners with respect to what we offer. And one of the common thing that we have seen, we interact with a lot of people who work. When they work, they have options of, opening their retirement accounts, fund money into those accounts throughout their lifetime. And not many people are fully aware also how this plan works. And sometimes we have to, sit with them and explain them how the current plan looks like, what exactly it has, the features, the benefits, the tax consequences, and all those things. So it's a huge opportunity for us when we get this chance to sit with them and explain them, because that's where we can also, analyze a couple of other options that's out there and help our clients diversify their portfolio, right? So always keep that in mind that I'm here to educate my client, to provide that, some information on what he has currently and what other options that he can get into. Don't just talk right away about products and all. Sometimes client see that as a sales pitch, so, and honestly nobody likes a salesperson. So let's continue that discussion. How do I bring that topic? How do I start a conversation? So one of the common thing is the retirement plans, which is very, very common. And I have seen in many parties also when we go a general get-togethers, this is one of the common topics that people do talk. One of them is politics, what's Trump's next move or what Modi is going to do. Or the third one is, or the second one is the retirement plans. And the third one is, are you planning to move back to India? If yes, what's your plan? So these are some of the common topics. And I've seen a lot of discussions on retirement plans, that how people are doing. So let's understand a little bit more and what people usually do. And I did this presentation, I think, a couple of months ago also, but it's a recap. It's again, so that when you see it again and again, I think you will come up with more questions. And for new partners also, it will be a first time look. So so the simple question you ask your prospect, your client, is what your current retirement plan looks like, what kind of, accounts you are having that you manage. The very common answer that you see is 401k. Most of, like 99% of the time is 401k. Means everyone who works have a 401k account, unless they're business owners, and then they might have, as Manish said, solo 401ks. Anyone who is self-employed, business owners, consultants, they can definitely open their own 401k. That is called solo 401k, and they can contribute into it and then they can manage. The only thing they don't get is the employer match, because they are their own employer and they are their own contributor also. And the other thing that some people like to do is IRAs, individual retirement accounts, and mostly it's the traditional IRA. Now, whenever someone do these things, there should be some logic behind it. There should be some reasoning behind it. So a lot of time when you dig deeper into that, asking questions like, hey, what are some of the advantages that you see opening these accounts or managing or maintaining these or funding these accounts? So by far, one of the common benefit that people say, like 10 out of 10, is the tax benefit, right? If somebody is maxing their 401k like $23,000 every year, the main reason is they are in high income, they are paying a lot of tax. So this seemed like a right away a good tax benefit, because the money that you contribute into this plan will be taken off from your income of the year, and you do not pay tax on that money. It doesn't mean that you never pay tax on it, but you're not paying tax at that point, at that tax year. So sometimes, it will help people to lower their tax bracket. Maybe if they are in 24%, they can get to 22%, right? Or whatever that reason is. But definitely it helps. Now, one thing I have noticed with a lot of, partners, when they see this 401k maxing and they are using it for tax benefit, they right away jump on top of it and they, oh, you don't know, it's tax deferred, you have to pay tons of tax, and when you retire, you are just scaring the hell out of them. We don't need to do that because there are advantages of doing this also, and there are disadvantages of keeping it for a long time. So it's not that it's a very bad plan. I personally contribute in my 401k. So if somebody comes and bash me that I'm doing the wrong thing, the conversation is going in a wrong direction. So we need to be very calm and understanding like why they are doing that. Do they really understand the logistic behind these plans? So just keep listening that hey, tax benefit, I totally agree that you get good amount of tax benefits when you contribute money to this plan because everything is tax deferred. And I hope you understand what tax deferred means, that we are not paying tax now, but we will pay in future whenever we need the money in retirement. So we are seeding that thought in his mind that it is tax deferred, but don't jump into it. You will be screwed when you withdraw money. There will be so much taxes. That leave it for later when you are on the same page with the client, right? So I agree with at that point. Yes, this is definitely a good tax benefit that you'll get right away. Same year. And depending on their overall financial situation, the household income, this could be a good idea also. I'm not saying it's a bad idea. We all need to see if this is the only asset they are building or this is one of the asset. So once you understand, once you do a quick FNA or talk few questions, ask few questions, you know that what kind of other things that they are doing. So in the whole scheme, it might be a good solution also. So don't just bash it, right? So other advantage that people see, and which is really a good advantage, is the employer match, right? Almost every employer, if it's provided, your 401k is provided through your employer, they match certain amount of money, and it's mostly in percentage based on your annual income. They match certain percentage like 3%, 4%, 5%. It used to be very high back then, like 8 to 10%. Few employers still do that, but most of them have gone down to 3 to 4%. So if you match 3%, they also match 3%. So that will be like a free money that you're getting from your employer. And then it is also going to compound over the years. So absolutely good idea to open your 401k account and at least contribute to the point where your employer is matching. I met so many clients and then they realized that, we did not understand properly the 401k and we did not opt for it for years and years. And now we are realizing that we missed so much money. So again, our objective is to educate them. Yes, this is definitely a good idea. Whatever match you are getting, contribute that much money so that you get full match, free money. Even if you have to, like, this is a confusion between a lot of H1 folks that what if I go back, in few years and what will happen to my money then, right? I'm contributing and it gets stuck. Even in all worst case scenario, if you have to take out all the money, surrender your 401k plan and pay the penalties, 10% IRS penalties and all those, still you end up with a positive number if you just have a employer match into it. So it's a no-brainer. If your employer is matching, highly, highly recommend to match it. So always, when you start your conversation, always start on a positive note. And this is one of the general rule of conversation also. Like a lot of time people ask, how do we start a conversation? Or even for prospecting also. If I'm approaching someone, what should I say? How do I start? So if you read any book that talks about conversation skills, the first thing that they say is always talk something positive about the other person or the discussion that you are into, right? If you're talking to someone and then you saw them and you want to initiate that conversation, you just find something that is good about that person. Maybe the dressing, maybe the shoes, the bag they carry, anything. Just one thing that you really feel it's good. And it has to be genuine. If you fake it, and if you say, oh, you have a nice hairstyle to a bald person, and that's the end of the discussion, right? So find something because people feel good when you talk good about them and about what they have. So once you start that on a positive note, now the things are rolling. Now you are talking. Now he's interested in listening more and you both are in a conversation. So in solutions also, whatever they are saying, whatever they have, find something good about that and appreciate that, right? If they are building something. So in this, yes, these two are some of the advantages that they have. And then we'll talk about what are some of the consequences that they have, or some of the things that are not advantageous at this point of time. So we all know most of us have 401ks from our employers or self-employed. So you always have some contribution limit into it, which is pretty good, like 23,500 for general uh, percentage of people, like a lot of people who are making 150 to $200,000, funding 23,000, it's a good amount of contribution that's going in there. So there will be cases where people are making good amount of money and they want to fund more, but they cannot. So the contribution limit can apply to some of the people, right? Now, you also know the money that's contributed into 401k, you are allowed to pick funds and allocate your money to it. That money is exposed to market risk, just like your other equity portfolio, your stock portfolio, that uh, you when you pick the funds, they always go up and down as the market moves. So in the long run, may not that be a big risk, but if somebody is close to retirement, they are already in 50s, this could be a major challenge. Because what if market goes down? And you can relate that with people who were retiring close to 2008, 2001, 2020, and when the market drops significantly and then they lose good amount of portfolio value in their 401k. So yes, that can be a good concern. But somebody who is in their 20s, 30s, this should not be a worry because they have enough time to regain from the losses. But at least our job is to highlight that point also. Why? Because most of our clientele, if you see, it's always most of the time it's between 40s, or above. Okay, so that's one of the things. Early withdrawal penalties. We all know it's an IRS regulated plan, so they have certain rules that you have to go with it. 59 and a half rule applies. So if any money that you take out before that period, that will be subjected to 10% penalty, right? There are some exceptions when you have qualified conditions, so as a loan or some, but consider that, most of the time it will be a 10% penalty on any money that's coming out. So again, depending on how young, how old that client is, it may or may not apply to that person. After 15 and a half, there is no penalty also. Now, one of the things, distributions are taxed. So this one is a big discussion point if they do not understand how 401k actually works. So, in simple way, you never paid tax on this money. So at some point of time, you have to pay. So when you start taking out as a distribution, it will be subjected to tax based on the tax bracket. And then required minimum distribution. This is also like IRS, forcing you to withdraw a certain amount of money at right now it's age 73. So basically, if you have not taken out any money throughout the period, like almost 73 also. And now IRS comes and says, hey, you have this big portfolio sitting there and you never pay tax on it, and we need to collect some taxes. So they pushes you. And if you don't do that, there is a penalty. It used to be 50%, but recently they reduced it to 25%. So for RMD amount, if you don't withdraw, you pay 25% of penalty, which is a pretty big number still. So a lot of retirees have concern about this thing because by that time they have built significant amount of portfolio. So even that around 3.5% of RMD will be a good number, and that will impact their other tax bracket and income sources. So sometimes if you are working with a client who is already close to 70 or late 60s, bring this point and see how much they understand because you should be able to help them here also. That how one of the plan that we offer, the annuity plan, the income that comes out of it will be part of RMDs also. They don't have to worry about that part. So that's there. Now, fees is is also subjected, like what kind of funds they have picked into their 401k plan. All right. If you pick something which is like it is tricky, like how do you show your client fees? Because it doesn't say on their statement that 401k custodian charge quarterly $300 or $200 or some percentage. It doesn't reflect clearly in there. But sometimes when the funds that you're picking internally, they charge you fees, the expense ratios, which is the fund fees that you're paying to have that fund. So that costs you or the prospect a lot of money, and they are not even aware of that. So now where you discuss this thing, if you start discussing this every client, it's not going to be a pretty discussion because most of the clients don't even understand they are paying fees. They just said, yeah, we are contributing, and one fine day we retire and we use this money. Simple, very, very simple, right? So, but some clients are very technical, right? They go into the numbers and they start comparing things with other stuff out there in the market. So there, it's a good idea that you also aware how the fees is calculated in a 401k. So this could be one of the exercise that we can do, pull up one 401k account and look at and calculate the fees of that account. But numbers are pretty staggering when you see that. So so see overall you should be smart enough when you are talking to your client, what point should I discuss more and go into the deep and what point I just touch base and go. No need to you go into the details. Because if you're talking to someone who's in 30s and you stress too much about RMDs, they cannot even, think that 73, that's a long way to go, right? So, and by the time they reach there, then the age may be, 75 or 80, so it may not even apply. So, find the right thing that is pertaining to that client and go deeper into that. That where you show your knowledge also, and that where you have a better discussion. So that's fees is there. Now, required active management, yes, 401ks. Usually you get a custodian, but they let you pick the funds, so you keep on either just find some good target date funds and set your account there and just let it grow with the time. Or if you understand too much about the market, you can always go in, change, funds off and on. Or some of them also offer a paid service where you pay some fees to an active manager, money manager who is managing your portfolio within the 401k also. Like Fidelity and other companies offer that. So if client is willing to pay, I would say it doesn't hurt if you don't know what you're doing and if you are taking some professional advice and pay it to them, right? So if I know my client Like if in the discussion I have figured out that they are using some kind of an service, advisory service, I would not put that down. I will appreciate that also. That hey, you are doing the right thing because we always should look to the experts for their opinion. Like if he's a doctor, I said, like people come to you for expert opinion on some certain health issues. Same way for your portfolio, you are taking advice from the expert there. So people feel again, it's again, we are trying to add value to them. What they're doing is a good thing. Okay, so there are so many things. Few others are employer linked. So every time you change jobs, you start worrying about now what do I do with my previous 401k? Should I roll over? Should I leave it there? This is one of the common confusion because people do change jobs every few years, and this is the same question. And a lot of them are not aware. They just move into the new employer, or some of them just leave it there, and they don't even realize that the fees structure changes when you don't roll over the money from the old company's account. So need to be again understand based on if they have any previous 401ks also. And legacy transfer challenges, inheritance. So this could be a very big discussion topic because 401k, as we know, tax deferred account. So we also need to understand what will happen if I'm not able to use all this money during my lifetime. And if it is going to my wife or husband, then what are the challenges or what will be that looks like? Or if it is going to my beneficiaries in terms of my kids, then how it will act. Because a lot of clients have not much idea about this feature. Yes, it can become a spousal IRA, but if it goes to kids, it used to be that they don't have to take out money as long as they don't want, but the laws changes. And now when it goes to the children's, they only have, or anyone else, they have only 10 years to withdraw all the money from the 401k. I am recently worked with a client, both husband and wife. They worked, very good throughout their lifetime and good savers, not too much in expenses, saved a lot of money. Now they're already in 70s and they have very hefty 401ks, 403b and 401k. So now when we were discussing and I explained them this feature, all of a sudden they are super worried now that and because see if you have not spent money throughout your life and you are kind of person who are okay to just eat regular meals and travel economy, you cannot change those habits overnight. That now I'm retired and I have so much money, so let me start traveling first class. It cannot happen. Or let me just go to all these big fancy restaurants and eat there. It is, it's a mindset thing that people cannot change. So they say that Anuj, we don't know that we have so much money in this account and we are not even using 1% of it. And what you're saying is if when it goes to our kids and who are already their doctors and they're already in high tax, and when it goes to them, they only have 10 years to withdraw all of it. So the way I see it, half of my hard-earned money is going into taxes to IRS. The money that we worked hard for throughout our life in expectation we'll use, but we are not going to use, and now it is just going in waste. And my kids will not even care because they're already making so much money. So if the tax bill comes, they say, okay, who cares? Just pay it. And there are no other workarounds. So only thing you can do some Roth conversions and all, but it's not going to be enough. So, so this point, I will still tell to younger clients that hey, I worked with a lot of people who are retired, and this is one of the major challenges that they see. That when money goes to their beneficiaries, there will be huge tax implications. because now they start thinking, okay, this it's not a good idea to build this into a big gigantic portfolio. So after all this, give me 1 second, please. I got my tea also, so I just want to take a sip. Okay. So after all these discussions, I will start. So like this takes, in training, we took like so much time, but in discussion with client, it not take more than 5 to 10 minutes maximum. Then we'll say, you know, let's say, you are a very good taxpayer and everything you are doing is great and good citizen, everything is good. And IRS is very, very flattered at you. And they say, Mr. Client, you design your own retirement portfolio. I'll give you full control and tell me what you want in your portfolio, what kind of features you are looking for. So, as if I am designing my own retirement account. So, what are the things that client want? They say, oh, I don't like this contribution limits. Whatever I need to contribute, I should be able to contribute. Whether it is $1,000, 10,000, 100,000, I don't care. So don't set any limit for me. Okay. And I don't like to lose money when market goes down. Okay. So we'll see about that. I want liquidity, no early withdrawal penalties because things changes during the lifetime. Right now, I don't see to withdraw money, but what if I need in few years for some other, investment, emergencies, buying homes or paying for kids' education? I want to make sure I can withdraw money without any penalties on top of it. Okay. What if I tell you that I don't like to pay tax when I withdraw money? Also, will that be a good idea? Okay. So you don't want to pay tax on distributions. You don't like RMDs. You don't want IRS to force you to withdraw money if you don't want to. And fees also, looking at what you're doing, it could be a good idea to have a less fees. And I don't like to manage. I'm super busy. I don't have time to do all those things. And I don't want to manage it also actively. Just, set it up and forget it like that. And I keep changing jobs also. So this rolling over is a big hassle to find out where the money is, where to move it and all, filling out those forms and all, keeping track of 10 different accounts. Not, I'm not into that. And what you were saying that, my beneficiaries will be subjected to a lot of taxes. So it would be a great idea if the balance of my portfolio, my 401k, will transfer to my beneficiary tax free or avoid any litigations, lawsuits, and all those things. That would be ideal. So basically, Mr. Client, what you are saying is all the consequences that you have of a 401k, you are asking to not have that and have a plan, something like that. Yes, that's exactly what I'm looking for. Oh, that's too much to ask, right? Do you think that that can even be possible? IRS will be willing to do that? Don't know. But what if I tell you there is a plan that does exactly what your dream plan looks like? Would you be interested in learning more about it? Now, what do you think? What will your client will say? What will be their answer? They will just jump on their chair and say, "Absolutely, show me what that is." Oh, that sounds like a great idea. And that's when you say it's not a big deal. It's a max funded IUL, max funded 77002 plan, which I can design based on your current, portfolio that you have. And you don't even have to come up with a lot of money, right? Because I already know that this client is max funding his 401k. So I use the term that let me just rebalance your contributions, your portfolio, and we'll find the money. You don't have to come up with a new money also. And that's where the conversation will be much, much easier when you now run an IUL illustration. That let me show you that if you fund $1,000 on a monthly basis that you are taking out from your current contribution of 401k, you still contribute 12, $13,000 there, which will be good enough to take employer match, but remaining 10 to $12,000 will go into this IUL. That will build you a portfolio which offers you all these features that I just talked about, right? Now, do you really now at this point of time you have to explain too much into your IUL illustrations? All you did, okay, see, I was talking about contribution limit. Here is that. Depending on how we are designing, you can contribute any amount of money. You let me know how much you want to contribute, I can design that way. And I'll still keep some buffer there so that you can, utilize in future. If your income increases, you can put more money. Since it's an index contract, you never lose money. You see this, the number never goes down. This column, look at that. So liquidity, the money that you see in the surrender column, you have access to that money anytime you want. No penalties on that, depending on how you're withdrawing that money. So all those, I will just touch base. I'll open this page and then touch base on all these things and connect in the IUL, and that should be a no-brainer for your client at that point of time. The only thing I need to see is if they're insurable, right? If they are in good health, and how I want to design this solution based on the other questions that we asked during the conversation. So it could be income solve also just to for the growth plan, or it could be a managed solution where they have good amount of coverage as well as building cash value into the plan as well, right? So it's all depend on how you are talking, and listening is the most important thing. So when you ask a question, do you know about RMDs, right? Then just zip it up and listen whatever they are saying. Let them finish their whole thought. Sometimes we jump into and cut them, and we miss. The more you listen, you will get so many pointers that will help you close. That's where the pain will come out. So this couple of slides that we shared have enough to raise those questions that they say, all these things that we just touch base, just that will be enough to poke into and hear about their pains, right? So it's just this simple solution. Uh, so any question so far? I think we are almost, what's the time? Close to 5 to 10 minutes more we have before we end our session. So I thought about running an illustration also, but I think we all have seen illustrations a lot. So maybe we can like look into some questions and see and use these things, guys. I don't know if you are taking notes or yes, recordings are there, but I see because it's a YouTube uploaded, I see the views. Not many people go back and see the recordings also. So I always recommend take notes. Doesn't matter if you're recording, voice record, video record. It is not going to help. If you write something down, I think it registers in your brain also. So take notes. Yeah, let's see who wants to ask. Hafiz?
Uh, Hi Anuj. Hello everybody. Uh, I have two questions. Like first question is about like say the fees for the 401k or the IRA. Could you tell a little bit more? I do remember you mentioned something about custodian fee, which could be roughly 300 or something, and there could be other fees as well. Um, how is actually the fee calculated in 401k and what are the fees associated with it is what I want to.
So, and that's what, if you listen to it, like I said, the number 300 is a sample. They,
Uh-huh.
depending on who is managing, what they charge, or they charge, I don't know. Every custodian is different. But the funds that you picked up into your 401k plan, the fund charges fees internally when you get invested. And it says not just 401k, it's an IRA or any investment account that you have, right? So there's something called expense ratio. You look at that, which means this is the percentage that they will charge before they credit any money to you. So that's what I said. This is a good exercise that what we will do is we'll open up one 401k account one day and look at and like a case study and go over all the details into that. But it will require a good solid hour to do that.
Great, great. Thank you, Anuj. And my next question is about the max funded 7702 plan, what you mentioned. And at one of the places you mentioned that while providing this to the clients, you do like say make sure that you have some buffer always. So for example, in this plan, I assume that uh, the contributions could be unlimited, right? Or is there like say still a limit beyond 23K, but then is there a still limit?
Yes, there will always be a limit, but that limit could be very, very high depending how you're designing. So for a person like you, let's say you are in 30s or 40s, 40, right? And let's say I design an IUL with 2 million death benefit,
Mhm.
right? Then your upper limit will be easily $120,000 yearly that you can contribute.
Wow.
So,
Okay.
so that's a pretty significant limit for someone who is working as a employee making 300,000 dollars. But that could be a small limit for a business owner who makes millions of dollars, right? So
Okay.
there is no point in designing 2 million worth of IUL for somebody who is not need that kind of a limit. So I can case by case, I can say for this person, I think let's go with 500,000 in IUL. And even if you start with $1,000 monthly premiums, you can still in future increase up to 2,000, $2,500 like that. So that is a balance that we will have to do. And this is something that we will learn with experience when we are designing more and more solutions actually for the client, not just mock solutions
Okay. What I hear is basically it mostly depends upon the age of
on the
the
death
person.
benefit.
Yeah, and the debt. Okay.
Mhm.
Thank you, Anuj.
Absolutely. Ashish bhai or
Hey,
Rita ji?
Anuj, how are
Yeah,
you?
I'm good.
Um,
Yes.
so one question I have, a lot of the discussion was revolved around assuming it was more traditional 401 and IRA. If people are mostly doing Roth IRA and only using the match for the traditional, um, now, the contribution limits are there, but RMD is not there, right? How should like this be perceived of when they have a pure or majority that's in Roth IRAs or Roth 401ks?
Yeah, first thing I'll definitely compliment them that, a lot of people are not aware of the Roth accounts and they are not taking advantage of them. So you are doing great. If you have a Roth account, IRA, 401k, that's absolutely great. Just continue to build those accounts and fund. Issue like diversification and the other topics that we touch with, it comes with some kind of living benefits. And so then I'll go into the discussion of the features that it offers in terms of death benefit protections and living benefits and the index contracts, like not losing the money when the market goes down. Because Roth 401k or Roth IRA is still subject to the market risk. And and I believe they could be part of the lawsuits and litigations and definitely state, right? So not the state. I think they are not, but I think for lawsuits and litigation, and this one is not. So they're still, again, not to bash that. It's not a bad thing. I personally do Roth IRAs also. So it's a diversification. So if client is already diversified into other things and willing to add on to another asset which has all these features, then definitely IUL will be a good feature.
Okay, thank you.
Mhm.
Yeah, Anuj, one more question. Earlier, when you were talking about the 401k fee, you mentioned custodian fee, but is it not custodian IRA for just the minors?
No, no, I'm not talking about custodian IRA. I'm talking about 401k.
Uh,
Custodian is the company who manages your 401k.
okay. Okay, got it. Okay,
Yeah.
understood. Okay, thanks.
Custodial IRA is a different thing. It's for kids. Yeah.
Okay, got it. Makes sense. Thanks.
No, thanks for clarification. Okay, guys, there are a lot of other people, new people also. I see every time same people ask questions. So I don't know is that they are the ones who understand everything or they have all the questions. Why not other people ask questions? Trust me, if you don't use this platform, this forum to unleash yourself, asking and discussing things, you cannot be a field builder ever. I guarantee that. I hate to say that, but if you are thinking to become a field builder and taking things in your control, you need to open up, you need to talk and discuss and ask. Otherwise, I I don't know. You may do some sales here and there, but if you are looking to build this business, build teams, the first thing is you need to come out of your shell and talk. Okay, Ralish bhai, I know
Yeah.
you wanted to say something. Since you're on camera, I'll turn on my camera also.
Okay.
So, I have three different questions, but I don't know if they make sense or not. Okay. So first thing is that if we ever start talking about, let's say, fees, so at the same time, uh, we say that like the custodian fees, this fees, that fees. So then like the client can come back so that like, okay, give me this plan. What is the fees in this max funded IUL? Or if you have if we get if the discussion goes towards the annuity, what are the fees in those plans?
Yeah, so let's not worry about the annuity today because annuity is totally different product.
Mhm.
Today's discussion is purely on the max funded IULs,
Okay.
right? So as I mentioned during the session also that fees is something I will only bring up when I'm talking to a very technical person.
Okay.
If it's a general client, and he just because most of the client don't even know how 401k works.
Okay.
So if I'm telling that person all the jargons of 401ks and internals of IULs and all, they will be lost and found,
Mhm.
and you will never able to close them. So
Mhm.
I'm just mentioning all these things in our internal presentations that these are the things that we can discuss with our clients. Doesn't mean that you take point by point and start talking to them.
Mhm.
That will go for forever and you will never close it.
Okay.
So, but you need to know that yes, if they are coming on the fees, they are talking about fees, you have a full ledger of fees in our illustration. If you check that box, it will print a page which has all the cost involved in IUL. And then you can compare side by side that after 20 years keeping this IUL or after keeping 20 years of 401k, end of the day, how much I paid in fees,
Mhm.
right? You will be surprised the number is way below what usually people pay in 401ks. What we see is most of the time as a financial professional here, the first few years of the fees. Oh, I paid $12,000. I only see 8,000 in my cash value. 4,000 just goes in fees. Hey, it's the initial phase when you're funding. Client has or company has a lot of liabilities attached to it. If the insured person pass away within the first month, company still have to pay this two, three, 400, $500,000 worth of death benefit. Who's going to pay for it? Right? So they have to save their back also. But
Mhm.
can your 401k pay you $500,000 if you just fund one check into your 401k contribution? Your family will receive 1,000, maybe 100, 200 more on top of that, right? So we are getting additional benefits. That's why we are, paying some cost towards it. There is no free lunch anywhere. So do not get defensive when someone asks cost question or fees question. I feel excited when they ask that. Hey, let's compare. Let's look at the number. It's a good exercise. I like when you're asking that because I love to discuss these things. So I get more involved with the client at that time. He should
Okay.
not feel like oh, he's asking fees question. Here you go. There.
Okay. But yeah. Now second thing is about like you discussed that like a legacy point where couple did not take out the money because they were a high net worth individual, your maybe a client or what. So I don't want more detail, but the thing is that at that time, what would you offer them?
Okay, so this particular case, these are retired people. They
Mhm.
were one of them is actually NIH a scientist.
Oh, okay.
Yeah, so I told him about Vinodji also
Mhm.
that I met him, so he was very happy that I worked with similar people. So he made good money through both of them were scientists. They made good money throughout their life. They are retired now. They have a lot of government benefits, pensions, and things like that. And at the same time, they were maxing their 403Bs. And lifestyle is very, very, general lifestyle, not like people who like to spend a lot of money. So no matter how hard they try, they are not going to use all of the money.
Mhm.
So right now, it is very hard to find out something like a win-win kind of solution for them. What I'm working on is, and that's when I also got my CP also got involved and working on some Roth conversions.
Okay.
That let's not uh, let's look at the current income and see how much we can convert into Roth every year. So what I'm working on solution side is, helping them with an income in annuities and also a long-term care plan.
So my question was like, can we not offer them the max funded IUL because of the age issue or what is that?
And that's another thing. It's not a no yet. So because I already submitted a policy for their rollover.
Mm-hmm.
So first I started with the will. So I am little different. So I do one thing at a time. I just don't open up everything. So first I help them with the will and trust. So it
Mm-hmm.
took 1 week time to get through the whole thing. That's done. Second thing, we worked on the annuity. So that's in process. We submitted the application. Once that is done, and I told them, okay, this is the second thing. Third, we'll work on your long-term care. And if I see a good combo plan, including some life insurance, so give me some time, let me explore. So they don't feel rush also, and they feel happy that I'm doing my homework. Okay, let me do some research, let me find the right solution.
Okay.
So instead of they say, give us some time, I say, let me have some time. Right? People don't like to be rushed, especially people who are retired seniors. They want things to go slow. So I will definitely help them with a legacy plan for sure. Once
Now,
I'm convinced that's a good plan.
okay. Now, one other thing is that in this whole thing, uh, where like when we s- give out this max funded IUL, now a person might say that like my money is in 401k where it is in the stock and growing really high. And like if I need to get the index contract, I can get it from my financial services like a Blackstone or anywhere else. Why do I need to do this?
How I still did not understand what do you mean exactly.
Like only thing is that like this max funded IUL is perfectly fine. Just return is not high, right? So that's if we get that question from somebody.
Yeah, so what kind of return you consider as high return?
Like over 10% return most of the time.
Consistently?
Yes. If
Okay.
that's a question from client, not me. I
Is
prefer
is
the
that? No, I did not miss what you said.
So like I prefer safety, but if the client is prefer like growth.
And I'm treating your client, that's why I'm asking these questions. And so what do you consider as high return? What do you consider as safety, right?
Mhm.
So do you like diversification?
Yes.
Do you like to keep all your eggs in one basket?
No.
So that's exactly what we're trying to do. You know, you have your portfolio, which is definitely going to, I'm 100% sure the way you are managing, it will continue to grow significantly. But in terms of diversification, with
Mhm.
all these features that I just shared with you, with the tax advantages and not losing money, inheritance, and all those things, let's let's diversify some of the money that you want to. So that should be good enough. And if see, you cannot win all clients. If somebody is super concerned about growth and if he's super happy with what he's doing, just let him do that, right? What's wrong with that?
Okay.
But well, this is a good way to ask questions. You are asking good questions. And client asks these questions.
Okay. Thank you, Anuj bhai. Those are my questions.
Okay, and it's a little bit
Um,
over. Let's see, anyone else?
Anuj, this is Neha here. So only one question. The inheritance part you said, right? So this max funded plan, you said inheritance friendly, so tax free transfer. I understand. So avoid probate. So we have to come up with will and trust, or is the plan itself that offers?
So your question is when it goes to beneficiary or
Yeah, when it goes to beneficiary.
so when it goes to beneficiary, you don't need will or trust it because if there is a proper beneficiary in the policy,
Mm-hmm.
that person receives the money right away. No need to be worry about will or trust. But
Okay.
if you are talking about state, like it will not be considered as part of my state also, which is again for high net worth individuals. It will not be added to my state. Then you need a different planning. That's when you need trust. So that's a little bit advanced topic, but for 99% of the client, just have the proper beneficiary and that should take care of it.
Okay. So, do we put will and trust, sorry, the trust as contingent beneficiary as well in this plan, like we do for other IULs or something?
Yeah, any insurance policy, whether it's a term policy, IUL, or max funded, doesn't matter. Any insurance policy that you're doing, the suggested approach is the primary beneficiary should be whoever you want to, the client want to, maybe the spouse or right, the
Mm-hmm.
first preferred person, and the contingent can be the trust. So
Okay.
that for any reason, if because sometimes what happen if like all the family members pass away at the same time in an accident or something, then there will be a challenge. The money gets stuck. But if the contingent is trust, so at least money goes into the trust and the successor trustees can still manage it.
Okay.
Or if the kids are minor and they are the contingent beneficiary, then they cannot have the money until they turn 18. But at least if it goes to the trust successor trustees can use the money.
Okay.
So yes,
Yeah.
always that's a suggested approach.
Yeah. Thank you. Thank you, Anuj. And thank you for the wonderful presentation. And it was I've got a lot of clarity.
Oh, absolutely, my pleasure. Okay, one last, anyone or any feedback also, because we definitely want more feedbacks. Like if you are utilizing this information and discussing, anyone else also wants to add anything, Prabhakar, Manish, or anyone.
I
Pritesh,
think
Great.
go ahead.
yeah,
Good.
go. Prabhakar, go.
Yeah, so
I just want to add, like one time we'll do that ILIT one, Anuj session, because a lot of questions coming on the trust and like Neha asked about. So we'll see how usually ILIT, is basically for high net worth. We'll try to have one
So
session
I
on
would,
that.
Prabhakar, I would not encourage to do a lot on that because what
Uh-huh.
happens, most of the partners are new,
New,
and
okay.
when they get into those discussions,
Hmm.
so if they come across a high net worth, they start handling them and they do not understand the whole dynamics and it will just go
Got you.
wrong.
Got
So
you.
if you get into any high net worth client, I would suggest to immediately get into touch with your field builder and find the right person who has done this so that they can help the client properly. You don't want to mess up their, that's why ILIT is little advanced topic. So once we understand the basics of all these things, and that's why I was asking, like if you understand, then speak up here, ask questions, say things. If you cannot discuss things here, forget about ILIT is such an advanced topic in is using irrevocable trust and all those things and how to fund it. You cannot talk to your client that thing. I can assure you that. So I know it's a good point, but only discuss with someone who's already working with high net worth clients.
Got you. And second thing, Anuj, the you mentioned 73 that RMD and it's a 72 and a half or it's recently changed.
It is 73 now.
Okay, got you. Thank you.
No, good point, Prabhakar. And
I would say and it's a great presentation. The only thing is that for new people especially, instead of focusing on the cost and other things, just focus on the last comparison slide that Anuj gave, the value that IUL products are adding to our clients. Because everything it has answer to all the questions that a client has. So if we just keep focusing on that, it itself is a closing thing for all I use. And I use that. I don't go too much detail into the the cost discussion and everything unless they have understanding of how it works. But just add value to the client and the closing happens. Thank you, Anuj.
yeah, no, and I agree 100% with what Manish said just now. And he's the one who's closing a lot of max funded IULs. So he's not just saying for the sake of saying. And I can assure you that when he discuss, cost is the last thing that these clients discuss. They are not asking, they just look at the value. So if you provide enough value, I think it will. And again, I'm not saying you should not talk about that thing, but let client ask those questions. Because if you get into those discussions, it's a very long discussion and you're just confusing yourself and the client. So yes, we need to know all those things, but not every client is willing to discuss that. So, but good point, Manish. Okay, and anyone else, or we're good? Okay, so that's good. Let me stop share. So thank you once again, everyone, for joining. Business is growing absolutely amazing, and we have a boot camp in Florida, you know, this month, 26, 27, 28. So if you're still thinking not yet confirmed, I highly recommend do not miss. And this is your chance to learn. If you like what I just shared today, this is like 10% of what I learned from a key. If you want to learn directly from him, just be there. Find whatever way you have to. Yes, there will be festivals and things here and there. Find one excuse that, okay, you know what, I'm going there. Or just for one day, just a Saturday, if you cannot do it for the whole time. Don't look at the cost, 800 and the flying. This is your investment into your business. You will be, repenting later on that, the cost of not attending this session will be huge. Learning from him directly, I would pay any money to do that. you don't get that opportunity. And when you meet a key in a spatial or a small sessions in a small group, he's a totally different person. I have seen that, I have learned from him, I worked with him closely. I know. So I don't know. I think most of the people who are here in this call are registered or coming. But if you're still thinking, have not finalized, decided, don't think too much. This could be a game changer. And tell your team members also, if they're not aware of these things, at least just bring one person with you and see the difference. But don't wait till the end. You have to confirm it as soon as possible, because uh, we have to block rooms and find the right size hall and everything. And for that, lot of preparations needed to accommodate everyone. So confirm as soon as possible. And whoever you're applying leaders are, transfer the money to them so that they can start booking everything. Okay, with that, have a good rest of your day and conquer your financial freedom. Thank you, everyone.
Thank you, Anuj.